name is Frank Santelli, and it is my pleasure to welcome you this evening on behalf of Mandeville and your Mandeville advisor. This event has been designed with you, our most valued clients and friends in mind. We wish to thank our existing clients for their patronage and the privilege of working with them. We welcome our guests and friends as we look forward to building new relationships. Now it is my distinct pleasure to introduce our keynote speaker this evening. Michael Lee Chin, one of Canada's most successful entrepreneurs and philanthropists, is widely regarded as a visionary entrepreneur whose philosophy of doing well and doing good has resulted in phenomenal business success and inspiring philanthropic initiatives. Michael is chairman of Mandeville Holdings, a privately held investment company which manages public equity, private equity, as well as having direct ownership interest in a collection of diversified businesses operating in sectors that include telecommunications, financial services, media, tourism, agriculture, and waste management. One of the Portland companies is the National Commercial Bank of Jamaica. Since its acquisition in 2002, the bank's profits have grown from net after-tax earnings of $7.5 million to $112 million. Last year, under Michael's stewardship, NCB became the largest bank in Jamaica. In 2007, Michael and the Portland private equity team created a $225 million U.S. private equity fund, focusing on investments in the Caribbean region. Investors in the AIC Caribbean Fund include a division of the United States government, the pension plan program of a multinational corporation, a fund of funds representing clients such as New York State Common Retirement Fund, European Investment Bank, and Export Development Canada. Among his many personal accomplishments, Michael has received Doctor of Laws degrees from a number of distinguished universities, including the University of Toronto, McMaster University, Northern Caribbean University, Sir Wilfrid Laurier University, the University of the West Indies, and York University. In 2008, Michael was awarded one of Jamaica's highest national honors, the Order of Jamaica, for his significant contributions in business and philanthropy. In 2011, Michael was appointed Chancellor of Wilfrid Laurier University. In 2013, Michael was selected by the Government of Ontario to receive the Queen Elizabeth II Diamond Jubilee Medal, and most recently, Michael was awarded a Lifetime Achievement Award from Wealth Professional magazine for his contribution to the financial industry in Canada. I draw your attention to the screen for a few moments.
Many of us fail to consider what is a fulfilled life. Over time, I've come to realize that a fulfilled life has three component parts. Number one, doing well. Number two, doing good for society. And number three, living a life of passion. Doing well is having enough wealth so that you can live the lifestyle that you choose, and having excess wealth that you can give back to society. Which brings us to doing good. We have to ask ourselves the question, what is our responsibility? We were born in countries that made us confident. We were born to parents who had values. And thirdly, we're born in an era that gave us opportunities. Conversely, there are many children who were born in countries that immediately truncated their confidence, who were born to parents who immediately, by virtue of having no values, no standards, expectations, truncated their confidence, and who were born in an era in which there are misfits. Therefore, we have to ask ourselves the question, do we have a responsibility to those of our brothers and sisters who are less blessed than we are? And finally, the third component is passion. Very successful people, very fulfilled people, they have a mission, they have a purpose that gets them through the air pockets of life. So the question we all have to ask is, what is my purpose? What is my mission? What is my cause? That is what gives you passion. Living a life of fulfillment, the concept is simple, not easy to execute over the long run. We have to be prepared to persevere through thick and thin. Ultimately, living a fulfilled life leads to one's legacy. Which reminds me of the story of the three stonemasons. This passerby, having seen these three stonemasons working day and night building this wall, decided one day to stop and ask the question, "Stonemasons, why are you here?" Stonemason number one, his response was, "I need a salary." Stonemason number two responded by saying, "I am the consummate professional." Stonemason number three said, "The real reason I'm here is because I'm building my cathedral." Now, who do you think will have the fulfilled life? Stonemason number three, every brick he lays, he makes a direct connection to his ultimate legacy. Our behavior today will be our history tomorrow. Make sure it's well written. I got my first lesson in investing when I was 10 years old, 11 years old. And it was my first day in high school. In Jamaica, we go to high school quite young. As I said, this was 1962. So as we were standing in this auditorium, not as elaborate as this, we were being addressed by the custos of the parish, who is equivalent to the lieutenant governor of the province. His name was Mr. Grosset. And Mr. Grosset, in this big bellowing voice, said, "Boys and girls, opportunity knocks but once." Oh my gosh, when I heard those utterances, I shuddered and I got fearful immediately. Because I thought, what if when my one opportunity comes knocking, I'm sleeping? Or I'm dreaming, which I did a lot, daydreaming, which I did a lot of that. Or I'm gazing, or I'm playing marbles. We didn't have TV then. Then my life is over. So for the next 12 years, I didn't sleep, I didn't gaze, I didn't dream, nor did I play marbles. I'm looking out for the one opportunity. Until this friend of mine said, "Mike, why do you look so sleep deprived?" I said, "Well," and I told him the Mr. Grosset story. So he said, "Oh, Mr. Grosset had it all wrong. Because every day there are opportunities. But unfortunately, for most people, when opportunities come floating by, they are invariably clad in a crisis. And when there's a crisis, how do you feel? How do you feel? You feel good? How do you look? You feel awful, right? And you look pallid. And you get paralyzed. So, Mike, remember the following. The Chinese definition of the word crisis has two component parts. It's like an equation. Crisis equals danger plus opportunity. When there's a crisis, most people focus on the danger. That's the reason why you look pallid and you feel awful. But remember, the second component part, opportunity. So, ladies and gentlemen, that was my first lesson in investing. Crises are synonymous with opportunities. Okay, whenever I'm feeling low, I've had a hard day, hard week, hard month, hard year. In the investment business, you have those. We have those, right? I always default to my living room. And in my living room, there's this painting. And it's a painting of a Caribbean scene in the days of slavery, 300 years ago. And this painting depicts the female slaves carrying bundles of sugarcane on their head. And the male slaves chopping the cane with machetes in the middle of the hot sun. And the female slaves are loading the cane onto an ox-drawn cart. And in the background, there is the sugar factory. So I look at this painting, I still do, and I say to myself, wow, those people, they are my forebears. Those people, irrespective of how much they dream, their dreams would never be realized. Irrespective of how much they aspire, their aspirations will never be realized. Their future is totally truncated. They could not own. They could not be educated, nor could they create wealth. Today, we have an opportunity to own, right? We have an opportunity to be educated, right? And we have an opportunity to create wealth, right? It would be an abject waste if given these opportunities, we did nothing with it, right? And that is the focus of my attention tonight. Number one, to talk about owning, to talk about, in some way, hopefully educating, and most importantly, to create wealth. As an advisor, I first came into the business in 1977. I was 26. And at 26, just leaving 2 years out of university, you know no one with money. And my job, I work for Investors Group, formerly Investors Syndicate, Main Street, West Hamilton. So my job was to get clients to buy mutual funds. So every time, and I not knowing anyone, I had to cold call. But every time I got a prospect, someone to sit with, and my office was their kitchen table, I would ask myself the question, what is the highest value added I can give to this family tonight? What's the highest value added I, as a financial advisor, can give to this family? And the answer kept resonating with me. Make them wealthy. Oh, really? Is there a formula that is no different from mixing 2 atoms of hydrogen with 1 atom of oxygen? You get water every time? Is there a formula for creating wealth that is as consistent? Is there such a formula? That was my quest as a young man, aged 26 years old. Is there a formula? Pardon me? Why don't you Google it? See what comes up. Nothing will come up. But it came to me in 1978, this formula. So we talk about this formula. And I'm going to prove to you that this formula is no different. We could say it is scientific. It's consistent in its outcome. Second epiphanic moment I had was after the crisis. After the crisis, I thought to myself, how did I get through the crisis less battered and bruised? How did I do it? And I thought about it, and the answer came back to me quite clearly. Oh, it's my private businesses that got me through the crisis, not my public businesses, my private businesses. And I'll give you the proxy of both. In 2007, I sold a business, Berkshire. You probably know of Berkshire. And by the way, for those of you who don't know our history, let me introduce our history to you. How many companies can you think of at one point in time was the largest shareholder of TD Bank, Loblaw, excluding the Westerns, Investors Group, excluding the Desmarais, Fairfax Financial, CI, Invesco, Mackenzie? How many companies can you think of in the world who at one point in time was the largest shareholder of all of those companies? Any? Which one? Right here in Burlington. Question. In Latin America and the Caribbean in 2014, what was the largest equity transaction done in Latin America and the Caribbean in 2014? What's the name of the entity? Pardon me? Columbus. How would you know? Columbus was sold by to Cable and Wireless. Where did Columbus originate? Where did Columbus come from? No, it's not John Malone. It was originated where? Right here on this property. It was co-founded by Mandeville Holdings and John Risley. And that was the largest transaction in Latin America and the Caribbean for 2014. We sold that business for $3 billion. So we have a storied history of creating a lot of wealth. So I think we may be qualified to talk about it. Then I'll ask you, can you name one entity who can name the United States government, the German government, the Canadian government, the European Investment Bank, Duke University, indirectly, the state of North Carolina as their clients? Can you name one entity? Right here. Right here. At 1375 Kearns Road. So we have a storied history, and it's a function of recognizing that the wealthy invest differently. The wealthy invest differently from you and I. As a young financial advisor, why are you chuckling? As a young financial advisor, I thought to myself, when I was selling mutual funds, wow, if I could ever tap into Mr. Ken Thompson, who was the wealthiest person then, if I could tap into his network, his financing, his knowledge base, wow, that would be the ultimate in investing, wouldn't it be? In other words, from then I thought co-investing with someone is the ultimate. Being on the same side of the table with an eminent investor is the ultimate in investing. Wouldn't you agree? But where do you get access to that? I didn't have access to that. But I knew intuitively that that was the ultimate in investing. Co-investing with people who have done so eminently. So the wealthy do invest differently. How differently? Number one, they make decisions based on a sound intellectual framework. They have a framework. They just don't make decisions arbitrarily. They go through a logical process and a framework, principles, they have a value system. But unfortunately, most of us, when we make an investment decision, we have no value system. And if you have no value system, no principles, you'll become arbitrary and you'll be scattering your opportunity. Right? So the wealthy invest differently. They make decisions based on a framework. So we're going to talk about framework. They make decisions not based on how they feel, whether they feel good or bad. They make decisions by controlling their emotions. And thirdly, the wealthy invest differently. Yes, they have access. So we're going to talk about access. So firstly, let's talk about framework. Framework. Who don't I know in this audience? Stick your hand up. Do I know? Have I met you before, sir? But who don't I know in this audience? So we have never met. Could you stand up, please? So we have never met. No, she's behind. I'm sorry. Oh, it doesn't matter. So we have never met. And I just want for you to say, stick your hand up if that's true. We have never met, right? Okay. So think of any wealthy person anywhere in the world. Could be Germany, New York, Canada, Australia. It doesn't matter. Don't tell me who. Right? Just think of a wealthy person. I don't know who you're thinking about, right? Because this is not a setup, right? But I am positive that I'll be able to define the 5 things that that person did to have created wealth. Now, anybody in this room did statistics in university? Anybody? Okay, young man here, bright and effervescent face. Okay, sir, how many people are there in the world? 7 billion? About 7 billion. And I'm going to define the 5 things that that person did, that person that this lady is thinking about, did to have created his or her wealth. The 5 things. And I have to get them 5 out of 5 right. Sir, is that a high or low probability that I get them 5 out of 5 right? Statistically speaking. High or low? Eh? You say, eh? I'm not guessing. I have to get it 5 out of 5 right. You can't guess. You can guess 1 out of 5, probably maybe 2 out of 5, but it's impossible to get 5 out of 5. Guess by guessing. So is it high or low probability? Eh? Very low. Near infinitesimal. She could be thinking about anybody. But I'm sure. And by the way, all of you should be thinking of someone. And I'm going to tell you what the 5 things that all of you are thinking. The person that you're thinking of, the 5 things that that person did. That's even lower, right? Because I have to get everybody right. So if I got everybody right, what does that tell you? What does that tell you? These are principles, right? That's a framework, right? if I get it all right, what should you be doing? Pardon me? Same thing. Does that make sense? Is that a deal? Okay, so let's go. That person you're thinking of, ma'am, created his or her wealth. Oh, by the way, let me just put some constraints to it. That person did not steal it. Right? That person did not win it. That person did not marry into it. Okay? Right? Okay, so that person you're thinking, I'm absolutely sure, created his or her wealth by owning a few high-quality businesses. Am I right? She said yes. Am I right? Huh? Okay. Number two, I'm absolutely sure. So we probably could conclude that wealth is created by owning, remember the slaves couldn't own, we can own, that person owns, by owning a few high-quality businesses. That's number one. Number two, that person you're thinking of created his or her wealth by making sure that he or she really understands those few businesses. So the key is understand what you own. Am I right? Two out of two so far? Thirdly, that person you're thinking of created his or her wealth by making sure that those few businesses were domiciled in strong, long-term growth industries. Am I right? Short of five. Fourthly, that person you're thinking of created his or her wealth by making sure that he or she used other people's money prudently. Am I right? Huh? Yes. 4 to 5, 80%, Dean's honors. And lastly, that person you're thinking of created his or her wealth by simply holding those few businesses for the long run. Am I right? Wow. But the probability was near infinitesimal, but I got it right. Did I get it right? So what does that tell you? I'm psychic. It tells you that wealth is created everywhere, irrespective of sector, irrespective of country, by doing 5 things, right? So if wealth is created by doing 5 things, what should you be doing? When someone comes to you and says, I have a mutual fund to sell you, what should you say? Does your mutual fund pass through the sieve of the 5 laws? Shouldn't you be asking that question? And if you did that every time, would your behavior be consistent? Pardon me? You sound feeble. Okay, so let us know, that was what I discovered. First thing and by the way, that person you're thinking of, I'm sure that the majority of that person's wealth was in private businesses. Am I right? Yes. That person created his or her wealth out of private businesses. And that person's portfolio is a composite of private businesses and public securities. Am I right? Now, you just read an article. Frank had asked you to read an article. Did you all read the article? Question is, that article was written by the Financial Post. There's a saying, ideas are a dime a dozen, but those who implement them are priceless. You read that article and ask yourself the question, does it make sense? Did that article make sense? Isn't the next question, how do I execute? How do I do this? How do I execute on this? So who does that? Can you go to the bank, the TD bank, and have that done? No. Can you go to your insurance company and have that done? So why did the newspaper write that article? To frustrate you? It's a definition of the ideals. But by the way, hopefully we'll all collect CPP. And that's exactly what CPP does. That's exactly what every single wealthy person does. That's exactly what Ontario teachers, owners, that's exactly how their portfolio is aligned. Am I right? Now, here's the dysfunctionality. Invariably, when you go to an advisor, what do you end up with? Do you end up with that? Or do you end up with a portfolio that's 100% publicly traded securities? Which? Former or latter? The latter. So if no one has ever created wealth doing the latter, why are you doing it? Why? Because most of us don't start off with a framework, right? If you don't have a framework, any road will get you there. It won't get you there, by the way. So let me just walk you through the logic. So as a young man, I discovered this at age 27, 28. And I thought, wow, when I sit in front of a client, I'm saying, what's the highest value added I can give to this family? Make them wealthy. So the first conversation I should have with this family is how is wealth created? And I just went through the framework with you, right? Those 5 laws, plus a portfolio, which is a composite of public and private. That's how wealth is created. That's the first conversation us as advisor, you should hear and you should want to hear. Because that's exactly what's done, right? But that conversation is not being had today anywhere. So let us test it. Your typical mutual, because I was selling mutual funds, right? And your typical mutual fund would have 100 securities, right? Right? Diversified. Anybody in this room owns mutual funds? Okay. So your typical mutual fund would own 100, 200, 300 securities. So now let us go back to those principles, the 5 laws, and see whether your typical mutual fund, generic mutual fund, passes or fails based on those 5 laws. That's the exercise I went through at 28. So law number 1, what was law number 1? Principle number 1. Wealth is created by owning a few high-quality businesses. Does your typical generic mutual fund pass or fail? Pardon me? Oh my gosh, what do you think as a young man I was thinking, this couldn't be so, because mutual funds are ubiquitous, they're governed, they're regulated all throughout the world. And this guy is saying it fails on the first count. Secondly, wealth is created by making sure that what you own, you really understand what you own. Does it pass or fail? If you own 100 different businesses, impossible. And most of us, we stack mutual funds. So if we look at our own portfolio, we may have 5 different mutual funds with 600, 700, 800 businesses. Right? So do we pass or fail? Wealth is created on the third principle by making sure that what we own is domiciled, or what we own are domiciled in strong long-term growth industries. If you own 100 different businesses, are you sure they're all in strong growth industries? Are you sure? So does it pass or fail? It fails. Number 3 out of 5. Number 4, wealth is created by making sure you use other people's money prudently. Does it pass or fail? Is it possible to, if you own 100 different businesses, are you sure you have 100 crackerjack chief financial officers? Are you sure? So does it pass or fail? It fails. 4 to 5. And lastly, your typical mutual fund has a turnover ratio of 60 to 80%, meaning the average hold period is 14 to 18 months. Name one business person in the world who buys and sells his businesses every 14 to 18 months. One in the world, please. Can you name one? So what's your conclusion, ladies and gentlemen? 5 out of 5. That was my conclusion. And I thought, Mike, you're probably a heretic. Because how could this be so? But I came to that conclusion only having a framework. Ladies and gentlemen, that's the importance of having a framework. Can you see it now? Because it gives you a direction as to what to do, and it also tells you what not to do. So, the most important decision we can make here tonight is to choose the right advisor. That's the most important decision you can make. You need to choose an advisor who is ensconced in a framework that is rooted in how wealth is created. And you need to have the conversation. That's the first, a philosophical conversation, a principled conversation, first thing. Doesn't that make sense? Tell me your framework. Ms. Advisor, what is it? I am going to give you my investable assets. I need to know what are the principles you're going to use so that I can measure you. Secondly, how are you going to control your emotions if you don't have principles? The only way to control your emotions is to make decisions, not whether you're feeling good or feeling bad, but make decisions by defaulting to your principles. Isn't that so? So if you don't have principles, you can't control your emotions. And lastly, tell me what access you have. Tell me what access you have. That will make me feel that I'm investing just like Ken Thompson. That will make me be convinced that I'm investing just like CPP. What access do you have? So if we don't go through that thought process and we don't question our advisors based on that, we're going to end up arbitrary and we're not going to create any wealth. And what we don't have is time, because as time marches on, we have less of it. And compounding works against us. So framework. is essential. I went through the 5 laws. Number 1, the framework consists of 5 laws, plus successful people created their wealth through owning private businesses. The wealthy people's portfolio consists of private and public holdings. Most of us, our portfolio is a composite of 100% public, stocks and mutual funds. That's it, and cash. So is there a difference really in attributes between private businesses and public securities? Is there a fundamental difference? Yes, there is. And I'd suggest to you that the bulk of wealth in the world is created in private businesses. This side. So let us look at the attributes. In a private business, invariably, the ownership is family owned. The ownership is concentrated, it's not widely dispersed. There is personal identification with the business, am I right? The management style you could describe as autocratic, right, Michael? Right, the management style you could describe as autocratic, am I right? The autocratic, entrepreneurial, and management turnover is low. When management, periodically, the business will make a profit. Periodically, the business will make a profit. So the profit has to now be allocated. So if the allocation is a good one in the private business, the net worth of the principals increases. Am I right? If it's a bad one, they go bankrupt. So the risk-reward ratio is perfectly symmetrical. Heads you win, tails you lose. Am I right? The board focus, the board is usually the family, is a long-term horizon and growth. And when the business is valued, it's valued based on the fundamentals, sales, customers, market share, margins. So these are the characteristics of how wealth is created in the private businesses. And this is how most people have created their wealth. So now let us contrast that to your typical broadly held corporation, public corporation. The ownership is dispersed and also anonymous. The management style, starting with the board of directors, is democratic, bureaucratic, and a high turnover of management. There is no owner. On the left-hand side, by the way, in terms of the principal private business, the owner is invariably an operator. So it's the owner-operator combined in one. Am I right? On the right-hand side, on the public businesses, invariably, the operators are not the owners. So there's a separation of ownership and operation. Difference. The management style could be described as democratic, bureaucratic, and high turnover. So what do I mean by that? Anybody owns a business in the room here? You own a business, ma'am? I'll go back. Sir? Okay, so you own a business. So your net worth is tied up in that business, right? Would you, sir, go out and nominate 6 other advisors, all of whom would have an equal vote to you, and none of whom have any skin in the game? Would you do that? Would anyone do that? No? Now, no rational business person would do that, right? Now, what is the highest form of governance in a public company? Isn't the highest form of governance vis-a-vis the board of directors to have the majority of the board independent? Am I right? And they all have equal votes, independent of the business, right? Isn't that the highest form of governance? But you wouldn't do that. So dysfunctionality. And by the way, they don't have any skin in the game. And by the way, they're not owners operators. So if you're not an owner operator, if you have no skin in the game, and the system of governance is one that the private business owner would never accept, but it is the highest form of governance in public businesses, there's something wrong. So that's what I meant by democratic risk-reward ratio being asymmetrical. In this case, whenever And we can think of many examples of when decisions are made. BlackBerry is a good one. Right? BlackBerry is a very good example. Board of directors, they had to fire the board of directors and bring in an autocrat, John Chen. Isn't that so? They shrank the board, am I right? And brought in someone who could make decisions. And he was incented to have that business turn around. So, typically, when your typical publicly traded company makes a decision, board and management get together and they make a decision to allocate capital. If it's a good decision, they get a bonus. If it's a bad decision, they get half the bonus. If it's a really bad decision, they get a golden parachute. Am I right? So it's like tantamount to flip a coin, heads you win, tails you don't lose. So that's what is meant by management risk-reward ratio is asymmetrical. Time horizon is based on the next quarterly analyst expectation. Am I right? So very short term, because your bonus is a function of meeting analyst expectations. Board focus, the focus of the board is governance, risk, and compliance. But that's not how the private person created his or her wealth. The private person created his or her wealth by being entrepreneurial and focused on growth. At the same time, pushing the limits of risk and compliance. Isn't that what we do? So if risk and compliance is your mandate and you have no skin in the game, what are you going to do? There's no upside. So you're just going to be very conservative and do nothing. And lastly, the valuation of the business is marked to market. Every day, the stock market trades, and we think the value of the business is based on the price of the stock. So you can see in this column here, the attributes are totally different from the attributes of a private business. So there is a difference. And again, I ask you, where is wealth created? In private businesses, more so than in public businesses. So therefore, if there's a difference, the conclusion is, when we buy a publicly traded company, should we not be looking for ones with these attributes? Should we not be doing that? Isn't that part of the framework? I beg your pardon? Am I way off here? I'm not getting any feedback. Should we not? So every time someone comes to us and say, I have a stock that you should consider, should we not be going through this framework? Okay, but how many times do we actually do that? So if we don't have a framework, we end up with being arbitrary. So what this slide tells us is every client, this row represents the needs of clients. Clients, all of us in this room, we have a need to preserve our capital. John Risley has a famous line, our partner in Columbus. Mike, I will risk my return. I'm not risking my principal. Right? It's too hard to make. So capital preservation, this is what he's saying, most important. Liquidity, we all need liquidity. At some point, we're going to need the income. We need growth, and we need to minimize taxes. These are our needs, right? So how are these needs satisfied in the standard approach? Through your typical broker, bank-owned firm, or independent broker, based on a portfolio of public fixed income securities, public equities, and cash only, 100% public. Now, the wealthy amongst us, including large institutions, CPP, Yale Endowment Trust, Harvard Endowment Trust, wealthy individuals, their needs are the same. But, and they too would have a portfolio consisting of public equities, public fixed income, cash. But in addition to that, they have a whole cadre of assets that we don't have access to. Private equity, direct ownership of businesses, venture capital, real estate, infrastructure, and resources. That's what that article that Frank asked you to read is alluding to. The model portfolio This is what the model portfolio should look like. And this is what has not been available at our level anywhere in the world. This is Mandeville's purpose. This is Mandeville's purpose. Because remember, I started off by saying to you, the crisis was an epiphanic moment for me. Because I asked myself the question, how did I get through the crisis less battered? And my conclusion was, it was these assets that got me through the crisis less battered. These assets, they're all marked to market. When I came to that realization, I felt awful. Because I've been an advisor since 1977, and all my clients whom I have been advising, they all own stocks and mutual funds. So I was doing exactly this since 1977. And my clients have done well because they had a framework, but the framework didn't include public and private. So I felt like I felt that I did not do a complete job. So I had two choices. I could have said, well, I'm no different from everybody else. Every other advisor does that. So why am I first? Or I can say, wow, there is an abject dysfunctionality in how clients are advised, generally speaking, and on the other hand, in what clients expect to get. They just don't know. So we're going to start a business that will because we are doing this for our own family office. We're going to start a business that will give clients access to all of these, which we have access to through our family office. And because of the clientele that we have and the network that we have. So that's Mandeville. Control of emotions. As Mr. Buffett said, investing is simple. What I do is simple, not easy. It's difficult to make rational choices when you're giddy. Times are great. It's difficult to make rational choices when times are awful. You feel terrible, right? But we need to find that middle ground. So what I do is simple, not easy. He said, Mr. Buffett also said, to invest successfully over the long run doesn't require stratospheric IQ. Whew, thank God for that. Unusual business insight or any particular inside information. What's needed is a sound intellectual framework for making decisions, and secondly, the ability to keep your emotions from corroding that framework. We have spoken at nauseum about framework. Heading of this, crisis equals danger plus opportunity. Rahm Emanuel. You never let a serious crisis go to waste. And what I mean by that, it's an opportunity to do things that you could not do before. He was President Barack Obama's advisor. Warren Buffett, be fearful when others are greedy, and greedy when others are fearful. That's how you control your emotions. Now, this chart, I love this chart. I love this chart because in 1990, I had a big fight with all my clients. I said to my clients, there is 1990, there is the Iraq war on. This is June of 1990, June, July, August of 1990. The Iraq war is on, and Berkshire Hathaway stock has fallen from $8,675 to $5,500. Please, clients, buy. Mike, are you mad? Buying a stock, one share of a share for $5,500? Are you crazy? Please buy, because let's go through. Is this a great business, Mr. Buffett? Business? Yes. Is it one that he understands? Yes. Is it in strong long-term growth industry? Yes. Is he a prudent user of other people's money? Yes. And is he holding for the long run? Yes. So therefore, they said, okay, I'll go along with you. And I was able to do that only because we had a framework. So that's 1990. In 1994, the U.S. government increased interest rates, and Berkshire Hathaway, the high for that year was $20,700, and the low was $15,000 in 1990. That's 1994. That's 4 years later. At $15,250, when it hit its low, what do you think my clients were doing? No, they're saying, Mike, we're fighting again. Mike, it's going down to zero, right? So we had a fight. But how did I keep them involved? Number one, is Mr. Buffett still owning? Yes. Does he how many businesses Mr. Buffett owns? One. Does he understand them? Yes, and go through the framework. That's 1994. 1998, similar story. Berkshire fell from 80,000 to 45,000. Same, at 45,000, same fight. Same drill. 2000, 71,000 to 41,000, at 41,000, same fight, same drill. 2006, etc., etc., etc. Today, Berkshire Hathaway is 226,000. Clients bought at 5,500. So, all my clients had this. I fought with all my clients. But today, they are appreciative that the framework is what kept them going. Because I can say to you, I have a client who fought with me viciously. He put in $80,000. He bought 16 shares in 1990. Today it's worth $4 million. 80,000 is worth $4 million. But we fought all the way along. And he would have only stayed involved because we had principles. And lastly, let's talk about access. Access to what? Access to the right people, access to the right institutions, access to the right products, access to competitive financing. Let me give you an example of what the power of leverage means and why it is law number, what? 1, 2, 3, 4, 5, which one? 4, use other people's money, right? What this chart is showing, if you take $1,000 and invested it for 40 years at 8%, you'll end up with $21,000. 40 years, 1,000 compounded at 8% will be $21,000. If you took the same $1,000 and leveraged it to 60%, use 60% loan to value, and every year you reset that loan to value to a 60% level, at the end of 40 years, you'd have 1.469 million. That's the reason, that is the power of using other people's money. At 10%, 1,000 would be worth 45,000. Doing this, it would be worth $7.5 million. The power of compounding and the power of leverage. And by the way, this, okay, so that's just a mathematical situation, but it demonstrates the principles. So let's talk about access to quality opportunities. I'm going to use some examples, just define in your mind what I'm referring to. And the promise is, whatever we are suggesting clients to buy, it should be the most erudite investor, the most knowledgeable investor should say, wow, I'd love to own a piece of this. So I'll give you some example of that. In June of 2013, I got a call from Cyril Arnaud. Cyril Arnaud, he worked for the European Investment Bank. And he started a fund by the name of the GREF fund. G-E-E-R-E-F. GREF fund. So he called me and said, Mike, in 2008, the European Investment Bank teamed up with the sovereign states of Germany and Norway. And we put $112 million into this fund, the GREF fund. And this fund is a fund of funds, so it's going to invest in other private equity funds. And these private equity funds that we are investing in, their mandate is to find businesses that will yield a return of minimum 20%. And those businesses should be all over the world and in the energy efficiency and renewable energy space. So European Investment Bank, Germany and Norway capitalized this fund with $112 million. So what we would now like to do is double the size of the fund from $112 million to $224 million. And hence the reason I'm calling you, Mike. We have selected 4 agents throughout the world, one in Asia, one in Europe, one in South America, and we're asking if you at Mandeville would be our North American agent. So please tell me about the structure. Ladies and gentlemen, what I was about to hear, and I am not an inexperienced investor. I'd never heard of a structure like that in my life. What you're about to hear, and I'm sure you're not an inexperienced investor, I am confident you would have never heard of a structure like this ever. So what did I hear? So Cyril said to me, okay, Mike, let's refer to the new investors coming in, us, as tranche B, investor group B, and the existing investors as tranche A, Germany, Norway, and the AIB. 112, 112. The new investors coming in, although the fund was started in 2008, will get, and this is 2014, it's 2015, the new investors coming in will get the same price as Germany, Norway, and AIB got in 2008. Stale dated prices, and that is legal. It's not legal in the securities industry, but it's legal here. When was the last time you've had an opportunity to buy, firstly, co-invest, invest beside? Remember I said the objective was to invest beside Mr. Thompson? To co-invest with Germany, Norway, and the AIB. When? Ever? I hadn't. So co-investing between eminent investors. Secondly, we are getting stale dated prices. When was the last time your advisor called you and said, look, if you buy this mutual fund today, notwithstanding that there's embedded pregnant capital gains in the fund, you can buy at the same price that unit holders paid in 2008. When? Doesn't that sound far out? But that's what I was hearing. I thought, this is unreal. If it wasn't coming from the AIB, which is the largest public financial institution in the world, I would say I'd hang the phone up. Continuing, he said, Mike, the tranche B unit holders, us, will get first loss protection. What does that mean, Cyril? He said, well, the second 112 million will be protected by the first 112 million. What does that mean? The fund of 224 would have to shrink from 224 million to 112 million before us lose any money. Have you ever heard of anything like that? Or, put another way, EIB, Germany, and Norway would have to lose all their money before we lose a penny. Okay, so that's first loss protection. In addition to that, when it's time for funds to be returned back from the underlying funds and given back to unit holders, the priority is the following. Notwithstanding that we came in now and they came in 6 years prior, we'll get 100% of our principal back first. And once we have gotten our 100% of our principal, we will get a further 4% annualized return. And after 100% plus 4%, Germany, Norway, and EIB will get their principal back. And when Germany, Norway, and EIB get their principal back, we'll get a further 6% annual return. So the score is 10% to 0. And thereafter, we split the residual gains emanating from the underlying funds. So if there's another 10%, Germany, Norway, EIB they get 5, we get 5. So the score is 15 to 5. Wow. Asymmetrical, but in our favor. So aren't you saying, why would they do that? Isn't that what you're asking? Why would they do that? Here's the reason why. Germany, anybody ever been to Germany? Norway, you drive down the highway, what do you see? Windmills all over the place, right? Norway, same way. Because they are at the forefront of green. Am I right? And they want to promote clean air. So they have a choice. They could take, these are developmental funds. So they could take the 112 million, they could take the 112 million and just give it as aid. Or they could shrewdly do the following. Take the 112 million, get us to put in another 112 million, that's 224, invest in 10 private equity, seed 10 private equity funds, and those private equity funds will now have the opportunity to get other people's money. So their 112 million was leveraged 20 times by the time you look at it, the total, you follow the money. So that's the reason why they're doing it. And their risk is, these are developmental funds, their headline risk is that they made 15 or 20%. Developmental funds are not, aid funds are not supposed to make commercial returns. So what they did, they shrewdly structured this in such a way to get the leverage, create more jobs, create more opportunities, and give us an asymmetric return. When was the last time you have heard of any structure like that, ladies and gentlemen? I had never. Only here. Because we start off with a clean sheet. We want to give access, and we have access. We want to give access to our clients, and we have access. By virtue of our reputation and who we do business with. And you may say, Mike, that's far out. Google it. Google GREF, and you'll see. And by the way, this fund was PCMA, the Private Capital Markets Association of Canada. It was awarded the Fund of the Year in 2014. This fund, only available at Mandeville. Second fund is, again, access. For people who are looking for income, a good way to get income it would be through mortgages. Mortgages, if they are well-placed assets and they're highly collateralized, very safe. So we have a private debt fund which is invested in mortgages and loans to medium-sized enterprises. And this fund in 2015 was the 2015 Private Capital Markets Fund of the Year. This private income fund, only available through Mandeville. Since inception, it has yielded 9.3% return to our clients. Now, I'm still in the category of access. Frank mentioned that we started a private equity fund in 2007. The private equity fund in 2007, and I won't bore you with the details, but we're investing in industries that would include communications, renewable energy. In fact, Columbus Communication was the first investment we made in this fund. And Columbus Communications, by way of the experience that we had, when we co-founded it, we all got shares, $1 per share. And our block of clients would include Burlington Holdings, us, and our private equity fund. And the limited partners would include, as I said, Treasury of the United States, Treasury of Canada, et cetera, et cetera. So those represented 1/2 of the ownership of Columbus. The other half was the John Risley Group, which included Goldman Sachs and Michael Dell. So the two halves got together, co-founded Columbus. So we all got shares, $1 per share in 2006, 2007, by the time the fund closed. In 2009, in the middle of the crisis, we got a dividend, 50 cents per share. So our average cost is now 50 cents. In 2012, we sold 20% of the business to one Mr. John Malone. John Malone is the largest private owner of real estate in the United States. He's second only to the United States government. His net worth is about $8 billion. He's the most successful telecommunications investor in the world. He sought us out and bought 20% of our company for nearly $300 million in 2012. Our clients got an opportunity to buy into Columbus at the same price as John Malone before it went public, $3.08. That's what he paid. Last year, in 2014, we got a second dividend of 47 cents. Remember, first dividend share price we got was $1. We got a dividend for 50 cents. Last year, 47 cents. We have 3 cents is our average cost. And so we got in March, the business was sold for $3 billion, $6.95 per share. So $1, we got our money back and we sold for $6.95. I contrasted that, and this was the epiphanic moment I was referring to, I sold Berkshire in 2007. I'd gotten shares of this large financial institution at $39.15. It's a publicly traded company, large insurance company. $39.15 in 2007, August. So I'm thinking, wow, at 10%, 7 years from now, the share price will double. $80. 7 years from 2007 to 2014. So I'm thinking, $80, I'll just cruise on my yacht. And the $80 will put my twin daughters through university. No problem. The reality is, the share price went from $39.40 to $9. Today it's $22, but it should be $80. It will never catch up. Because if it compounds at 20%, 10%, it's going to go from 20 to 22, whereby 80 is going to go from 80 to 88. So it will never catch up. So that's when I thought, wow, there is my clients, they got fully hit because they owned 100% publicly traded securities. I was protected a little bit by my private assets. They took the full impact of the stock market crisis. I didn't feel too good about that. That's the reason when I said, we're going to start a business that will give clients the opportunity to build portfolios that are composite of public and private. And the public businesses must meet a certain criteria. I just went through the criteria. They must look more private-like in their structure and form. So this is the network, Columbus Network. We sell broadband to every single Central America, Mexico, and every single Central American, South American country. This business we started here in 2006, 2007 with zero cash flow. When we sold it, it had nearly $270 million in cash flow. We sold it for, it had zero clients, not clients, zero staff. When we sold it, we had 2,700 staff. And we had, so that's the Columbus experience. So today, where are the opportunities to this? Number one, what we did, the principle of what we did with respect to Columbus is the following. And I'll just put it to you in terms of a question. If you could go back in history and invest in Rogers 40 years ago, if you could go back in history 40 years ago and invest in Rogers, would you do it? Would you do it? Why? Because you've seen that how the movie has played out, right? So that's an easy one. So the question is, the logic would be, why don't we find an area or areas where that movie is just about to play and go flip the switch? Why don't we do that? That's what we did with Columbus. So the question today is there another, can we do a replay of that? That's the question. So Columbus, what were the component parts that we saw and we put together? Rogers consolidated a fragmented cable industry in Canada, right? Rogers, BCE, Shaw, all right? There was a management team that did the same out of Eastern Canada. The company was Persona Communications. So that was bought out, and the team was left stranded. So we took that management team from Canada to the Caribbean to buy up the fragmented cable companies in the Caribbean, right? So we had the expertise, we knew the team's acumen, and we knew the opportunity, and we had seen the movie before. So we don't like to jump 10-foot hurdles. We prefer to jump 1-foot hurdles. And if you buy a cable business, it's hard to lose money. So we're currently doing, and here's an opportunity for us today, which we're seizing. We're currently doing the same exact thing in the power generation sector right now. Because we can buy a power plant that is paying a dividend yield of 10 to 12%, in fact higher, 10 to 15%, with long-term contracts, so we're not going to lose any money. But if we were to, a typical power plant, power yield asset fund in Canada, Emera Corporation, Fortis, would yield between 4 and 6.8. So if you can buy an asset that is yielding 12, and you can vend it into a business that's paying out clients 6, in effect, you'll double your money instantly. That's how Mr. de Groot built Laidlaw, right? Mike de Groot built Laidlaw. Buying private and selling public, basically. So we are doing this now in the power sector. And our clients are participating in that opportunity. And the last category, in terms of access, the last time we had a meeting here, clients could not access most of these products because they were limited to the accredited investor. The rules of Ontario have changed were changed on May the 5th so that clients can now, who are not accredited, can now access these products. Because the test for accreditation is not on the client, it's on the portfolio manager. So it's the portfolio manager's responsibility to make sure that the client is suitable. But the point is, clients now have access. And that was spearheaded by Mr. Frank LaFerriere, our Chief Financial Officer. Frank was the chief lobbyist to really have that situation change, because that is the right thing to do. And so we're breaking ground right here from 1375 Kearns Road. So whatever was mentioned here tonight in terms of the private securities, all of you have access to it. You all have access to it now. Before, only the accredited investors had access. So, in summary, the wealthy do invest differently. Number one, they have what? A framework that they're dogmatic towards. Number two, they can control their emotions because of their framework. And thirdly, they have access to people who think likewise, similarly, access to good funding, access to good products and assets. Our mission is to bring that access, which we have by virtue of our reputation, our clientele, the fact that we own businesses throughout the world. We are bringing that access and making sure that our clients, too, can have the opportunity to fulfill their dreams. Thank you very much.
Michael, thank you for that informative and inspiring message. We have a few moments for some questions.
So, before we take the first question, I'd like to read to you my anthem. It's entitled Our Deepest Fears by Marianne Williamson. Anyone heard of that anthem, that poem? Would you like to come up here and recite it? No? Our deepest fear is not that we are inadequate. Our deepest fear is that we are powerful beyond measure. It is our light, not our darkness, that most frightens us. We ask ourselves, who am I to be brilliant, successful, talented, fabulous? Actually, who are you not to be? You're a child of God. Your playing small does not serve the world. There's nothing enlightened about shrinking so that other people won't feel insecure around you. We're all meant to shine as children do. We're born to make manifest the glory that is within us. It's not within some of us, it's in everyone. And as we let our own light shine, we unconsciously give other people permission to do the same. As we are liberated from our own fear, our presence automatically liberates others. Thank you very much.
But my question to Michael is, it sounds like since the crisis of 2008, 2009, your platform and portfolio has evolved.
Yes.
Having said that, it seems like you've gained and accessed all these great partners.
Yes.
One of the key partnerships I really enjoyed hearing tonight is that new Portland mortgage portfolio or product.
Yes.
If someone has interest just in that specific product,
yes,
is that a possibility?
Yes.
Okay. One other question regarding that product. On an annual basis, since it started in 2013, how many dollars have been funded through that?
Where's Chris Lowe? Chris Lowe. Chris is the portfolio manager.
Hello, yes. So since we started the fund, we've funded about $16 million so far.
16 million in an annual 12-month period or for the last 36?
No, over the period of time. So when we actually initially started the fund, I think we've already thanked Frank LaFerriere and a few others. Some of us put our own money into the fund and initially started it, and initially invested in one mortgage and grew our understanding as we went through, as we worked with some of the partners, and now have actually been expanding that message through for the last 2 years. So we've been moving up. So the first year or so was just a few $1 million, and in the last, each month now, we're probably taking on about $1 to $1.5 million a month.
Excuse me, Chris, just mentioned that it's not open to non-Mandeville advisors?
The product is available to Mandeville advisors and the Portland
Only.
folks that are in this room as well.
Okay, the next question I have is, on those mortgages, are they funded locally within the province of Ontario, or are they going outside of the province?
So thank you for these questions. The fund is, the partner that we work with, particularly for the mortgages, is a company by the name of Marshall Zare. And they're based out of Kingston, out of Waterloo, sorry, and Kitchener, beg your pardon, sorry. I'm having a colonoscopy in 2 days' time, so my memory. You've got to work with me here, because I'm
It's
thinking,
understandable.
I've got
I'll
the
give you that.
passion
I'll
and I've
grant
got
you that
the incentive, but
Have
my
a
wife
good time
tells
with
me
it,
I've
by
got
the
a
way,
lot
if
to
I'm
look
not
forward to.
gonna
So
join
you can hit me with these questions, but I'm focused on something else right now. These folks are based in Kitchener, and so effectively we've been working exclusively with them. Their bench strength is in Ontario, starting in southwest Ontario. They're pretty much through Ontario. We don't look at condos in Toronto. So basically, it's areas which are intensifying, where the exit for the mortgage is very clear, and it's folks, it's developers who we've worked with for a while, we've got an understanding with, and we get therefore a good relationship and a good return from
And they're
them.
all second mortgages. So, is that correct?
We're co-investing with the Zare family.
Sure. Sorry, I missed the question.
And they're all second mortgages, correct?
No. They are. They can be a mixture of first or second. Typically, the second mortgages when there's already a large number of pre-sales of whatever's being built, and therefore we're prepared or comfortable, perhaps even more comfortable, to come into a second position in order to allow an insurance company to actually be providing the security to whoever the folks are that have put their deposits down to be able to facilitate the mortgage. Initially, the fund, I think Michael was just reminding me that one of the reasons we developed a close relationship with Marshall Zare is that the company, the founding members, Dave Marshall and Greg Zare, put a significant amount of their own money into the business as they grew it. So their capabilities now are running close to $1 billion, and of which initially when we first met them, they were at 300-400 million, and a large chunk of that was their own money. So from the point of view of when we started to look at the mortgages and the opportunities, we recognized that their own skin was in the game and that they were particularly keen for these products to work. So that's the relation. The fund has been going for about 2.5 years, and my relationship with them has been going for about 5.
So the sub-advisor, Marshall Zare, they would have how much in total assets?
So totally, as I say, about $1 billion they're
billion,
looking
okay.
after now, yeah. Through retail and through institutions.
I have one question for Michael. On a daily basis, you must receive numerous emails about opportunities to invest in. With your strong management team, how do you source out the good from the bad? And how do you sometimes say to yourself, well, I missed a good opportunity, or I didn't see that quite well, because you had someone in the middle that reluctantly didn't present that to you. How's your, or what's your perception on that?
Okay,
And then I'll end all my questions and let someone else step in.
Invariably, we don't respond to someone emailing us with investment ideas. We have built a network, a platform of companies that we own, that we see them because they are in-market operators. They are seeing deals, they are seeing opportunities much quicker because they're operating within the marketplace, and we get information based on our own network of companies that we own. And by virtue of the fact that we're also a part of the private equity fund community. So it's just the networking and the platform being provided by the companies that we already own, and the fact that we are part of an investing community. The fact that in the case of GREF, the fact that our clients would include the limited partners that I mentioned earlier. So to answer your question succinctly, we very rarely get our ideas from incoming emails.
Oh, just a little piece of advice for Chris. In 2 days, make sure you get a second opinion. Don't go by the first one. Michael, my question to you is, what is your opinion on the price of oil, where it sits right now? And what do you expect in the next 6 to 12 months? Your own opinion.
I anticipated that question, so I brought a slide for it.
This was a setup.
No, it wasn't a setup, by the way. It wasn't a setup. We're very excited about the price of oil. It would have been a year ago. Yes, June, a little over a year ago. And we just didn't see the price going from 100 to 40 to 60. We just didn't see it coming. Nobody saw it coming, right? So if I were to say to you, I expect that the price of oil will be 100 in a year's time, I'd be lying. I just didn't see it coming. That about the last year, so I can't say I'm going to see. I can see it. All of a sudden, I just didn't become crystal clear. But here's what I know: because low oil prices will stimulate low oil price in itself will stimulate more demand. So there are the two equations here. The demand driver. Lower oil prices will stimulate more travel, which is increasing demand. Are we seeing, is that happening? Can you see that happening? Low oil prices will stimulate the sales of gas guzzler. Is that happening? Yes. Low oil prices will stimulate economic growth. Is that happening? So all of those these factors are growing towards what? More demand, right? On the supply side, low oil prices will reduce exploration and production, capital expenditures. Is that happening? Low oil prices will curtail exploration and production, financing. The cost of financing will go up. Is that happening? Yes. And lastly, low oil prices will affect oil-producing countries. This is not yet happening. But you can see the demand drivers and the supply drivers will work towards higher oil prices over the long run. So this is now an opportunity to get involved. I don't know what's going to happen in the next 6 months, a year, but I know we're not buying at the peak. And I know today we can buy Crescent Point Energy, which is giving us a dividend yield of 10%. And Crescent Point Energy has their oil production hedged for 2015 and 2016, the bulk of their production, at $70, $80.
We have room for time for one or two more questions. Please. First the young lady and then the gentleman.
Hi, good evening. This is for Mr. Lee Chin.
Yes.
Great introductory video. The video is really good.
Thank you very much.
Quick question. I'm sure you've already alluded to some of them in your presentation, but I have 3 simple questions. First, what's your purpose? What is your greatest fear? And how would you describe the culture at Mandeville?
So what's my purpose? Ever since I was a young lad, I've always studied eminently successful people. And I noticed that eminently successful people, they were all driven by a cause, a mission, a purpose. So my search was, what is that cause, mission, that I can live my life with and be a martyr for, and stand up and say, no, notwithstanding, it's being done this way by everybody, it's wrong. And here are the reasons why it's wrong, which I think I did tonight, right? So my purpose is everything I own today, all the accomplishments I've had to date, is a function of those individuals who were my clients from the get-go, right? They supported me. The fact that I can buy a suit is because my clients supported me then. I also gave them good advice. So when I look at my industry, I'm not happy with the level of advice that's being given, and that is what the level of advice that is being, and the advice that is being accepted in terms of what clients want to achieve, which is to create wealth. As I pointed out earlier, the advice given will not lead to wealth creation. So my purpose is to change that. What's the second question?
Thank you.
What's
your greatest fear?
My greatest fear? I observed an experience over the last, which started in 1981 when interest rates were 23%. And it was this gentleman who owned a Chrysler dealership. It eventually went bankrupt. Anyway, the summary of the story was success begets complacency, begets failure. That's my summation. Success begets the natural byproduct of being successful is just stop doing the things that made you successful. Right? Natural. And once you stop doing the things that made you successful, you're also doing something else. You're going to get a different result. So my fear is that I become complacent. And I stop doing the things that I did when I was really bright-eyed and bushy-tailed. So I'm caught. So I used to get up at 5. I still have to get up at 5. That's my fear. If I don't get up at 5, I'm thinking, whoa, I have always swum upstream. If I'm not swimming upstream, I feel that there's something wrong. Right? Because success begets complacency / arrogance. You become successful. The natural byproduct of being successful is I can do anything. Right? Then it's a different outcome. Right? So that's my fear. I become complacent. What's the third?
The third actually just stems from the saying that culture eats strategy for breakfast.
You mentioned Mandeville.
I wanted to know, how would you
The
describe
culture
the
at Mandeville
here?
is exactly as I've defined for the last hour. We have a cadre of advisors who eat, breathe, sleep the principles, the framework, who have and they have access, and their passion is to make sure that irrespective of who they're speaking to, they can democratize what has hitherto now been only the purview of the super wealthy and make sure that everyone has an opportunity.
Okay, thank you.
You're welcome.
Station number 1, and then we'll close at number 4.
This is from Michael Leachin. I'm a advisor, and 2 of the founders are here tonight. A Caribbean telecom that is flying under the radar, that has disruptive technology, that is currently has a startup in January, spent the last 4 years acquiring all the appropriate licenses, and they are taking customers away from cable and wireless and Digicel at an alarming rate right now.
Not Flu.
Not yet, but,
Okay.
but soon. And I'd like to get access to you or to one of your advisors to walk you through that.
Rob Almeida, where are you? Rob. Where's Rob?
He's in the back.
Turn around, sir. That gentleman who is waving his hand. Go and speak to him.
Okay, great. And as an aside, my sister Laura
Yes.
worked with you on Main Street in 1977. Laura Cathcart, she's here tonight.
Really? Yes, of course, I remember Laura.
When you were
Hi,
26.
Laura. Yes, at Investors.
You guys used to drive downtown to
Yes,
Chinatown.
hi,
and get
Laura.
yams.
Whoa. Thank you very much for mentioning that to me.
All right.
Wow. You made my night, sir. Thank you very much. Laura, good seeing you. Eh? The good old days with Fred. Anyway,
And our last question comes from
Andrew Johnson. Remember Andrew? Yeah. I'm sorry, ladies and gentlemen.
our last question will come from a gentleman at station number 4.
Hi, Mr. Lee Chen.
Yes, sir.
My question is, for someone like myself who works Monday to Friday, single parent,
Yes, sir.
lives check to check, that shows up here and I'm curious, I want to get ahead.
Yes, sir.
What should be my first step?
Well, it's interesting. Goldman Sachs just wrote a letter to their interns who are just coming in. And the letter was saying to them, they have to leave work before midnight. And they cannot come to work before 7. And they must take off Saturdays. Does that answer your question, sir?
Somewhat.
There is no other formula.
Okay.
And if you're passionate about what you do, it's not work.
All right.
So, in other words, make sure you identify something that you're passionate about so that you don't have to work another day.
Thank you.
Thank you, Michael. And I'd like to take a moment to thank each of you for joining us here this evening and taking time out from your busy schedule.